Joining us right now is ExxonMobil's CEO, Darren Woods. And Darren, it's good to see you this morning. Thank you for being with us.
Good to be here, Becky. Thank you.
So let's talk a little bit about the numbers for what we've seen in this most recent quarter. Obviously, the biggest story that's been impacting all of big oil companies has been that huge rise in WTI. What did that mean for you this quarter?
Well, I think the first quarter results reflect what is an improving market, but more importantly, it reflects the significant work and the strategic investments that we've been making over the last several years to reshape our portfolio to be amongst the best and most price competitive portfolio of assets in the industry. And I think we're starting to see the results of that work manifest themselves here in the first quarter.
Is that around results for U.S. shale? What are you talking about?
So back in 2017, we started a very concerted effort to improve the earnings capacity and cash flow generation capacity of our asset base by developing a very advantaged set of investment opportunities. We restructured the organization in 18 and 19, basically moving 16,000 different jobs, organizing along value chains, which have given our employees a much better line of sight to the business, end-to-end profitability and accountability for that profitability, and simplified the org structure, eliminated a lot of organizational interfaces and the friction that comes with that. So I think we have a much leaner organization that is more focused on the bottom line results, and our employees can relate their activities better to those bottom line results. And that's, I think, what we're starting to see here in the first quarter.
Part of that also was a big cut to capital expenditures. It's the same thing we saw from many oil companies just responding to the drop in oil prices. Are your CapEx plans still in place from the most recent that we've heard? I think it's something like $16 to $19 billion for this year and then $20 to $25 billion through 2025.
Yes, they are, Becky. We're still pursuing. Our CapEx plans are still in line with that outlook. As you said, and as I mentioned, we have built a very advantaged set of investment opportunities. All those investment opportunities are intact, but as we went into the pandemic and saw the impact on the industry, we had to reprioritize and continuing to invest in the highest return projects and then starting to pace some of those other projects. And we have plans today to bring those back online as the economies improve and as the industry outlook improves. Those will be ramped up, and that's consistent with the outlook that we put out as part of our Investor Day and, in fact, last year after the board approved our plan.
Hey, Darren, you've been dealing with a lot of activist investors this year, and some of them have backed down, have reached agreement with the company. But you did have engine company number one kind of doubling down this week, reiterating their complaints, I think, in an 80-page letter that they put out. They want to see changes at the board. They want to see people put into the board position who are going to be more reactive to climate change. It's been a big battle, and it's been surprising to see the three largest pension funds back them and say they go along with it. Right now, we have not heard from your biggest investors. That would be BlackRock and Vanguard. But where do things stand right now? What can you tell us?
Well, you know, when that came out back in December, as you said, two activist investors that we engaged with, I and my lead director, Ken Frazier, talked with both of them. I'd say if I take the first activist, D.E. Shaw, had a very good, constructive conversation, talked about the objectives, talked about how best to achieve those objectives. And I think through the course of that conversation became very clear that we were aligned on the objectives of growing shareholder value. And as those discussions progressed, aligned on how best to do that. And as we rebuild our plans that we had developed in 2020, I think got general alignment around where we're taking the company, the benefits that we think we're going to see. And I think general agreement that we were on the right track and the right approach. We did went through a very similar process with engine number one. And I would say, you know, we agree certainly on one objective, which is making sure that the company is well positioned to deal with the transition and to help society more generally evolve to a lower carbon future. But I think when it comes to how best to do that, engine number one wasn't particularly interested in engaging and understanding how best ExxonMobil can contribute to that and grow shareholder value while transitioning to a lower carbon future. And frankly, they're pushing us to wind down our investments, wind down the business, move into solar and wind where we don't really have a competitive advantage. And so had difficulty reaching any understanding as to how best to move forward.
Shepard Smith here. Thanks for watching CNBC on YouTube.